Yes, you've read the title right. I'm probably buying more Amazon shares today. So some of you might be wondering, why would I be chasing the highs? Especially when Amazon is up by more than 6% in the pre-market and it's trading near $170 after delivering a monstrous Q4 of last year. So to frame the thinking more accurately, I'm not buying Amazon despite the large gap up in price action. I'm buying Amazon because of the incredible earnings they've pulled off. I want a little bit more of that spectacular business. So full disclosure, I currently have an existing Amazon position, nearly 45 shares at a cost basis of right around $125 per share. So if you look at it on a portfolio level before this rally, Amazon is currently sitting at right around 6.56% allocation. But on a cost basis, I've only allocated 4.6% of my monies to it. So long story short, I basically think that it's not enough. That's why I'm intending to allocate more money to basically beef up the allocation a little bit more. So you know what you can do to help? You can help me beef up the like button while you're at it. So let's talk about Amazon's recent earnings. What happened? So to draw the stark contrast in investor sentiments, on the 28th of October 2022, Amazon reported Q3 2022 results with free cash flow at negative $28.48 billion, which was down 222% year on year, and the stock closed the trading day at $103.41. So Amazon, the king of e-commerce and cloud, one of the most respected disruptors in the American business world, negative $30 billion in free cash flow. Most investors were basically in it for a rude shock, and some were even skeptical of whether Amazon is even able to make a profit anymore. This time, however, garnered a completely different response. Amazon came in beating on every single metric with significant cost optimization and incredible growth. Revenue was up 14% year on year, operating income was up 383% year on year. When diving into individual business segments, online stores 9%, physical stores 4%, third-party sellers 20%, advertising 27%, subscription service 14%, and AWS 13%. So other than online and physical stores, which are the first two line items, which are the lowest margins of the entire Amazon's empire, everything else grew in healthy double digits, which also contributed meaningfully to their bottom line, with an expansion in operating margins to high single digits now, right around 7 to 8%. So this expansion in operating margins is a validation to the Amazon story that was peddled by Amazon backholders. And congratulations to all of them who have seen through it. So for Amazon's advertising business, I'm just going to play a short snippet of a video that I made in early 2023 discussing about the differences between the ad giants and contrast Amazon's potential with what Alibaba has managed to achieve and amassed, and I'm still of the opinion that Amazon has an incredible runway ahead on monetization. More importantly, what I wanted to point out is actually Amazon's advertising business. So let's just forget about their retail business and their AWS segment. Let's just focus on the advertising services. The advertising services is actually up 19% year on year on a relatively huge advertising revenue base with $9.5 billion. Sure, if you just look at it from vanilla terms, Amazon out of the three has the smallest revenue base. But I think the market is slowly waking up to the potential of this advertising business that Amazon has in their arsenal. And I think long story short, at least in the upcoming decade or so, based on my own projections and my valuation model, I do see a potential where Amazon's advertising business becomes even bigger than Meta platforms by the end of this decade. Who knows? That's just my own speculation. But maybe just to drive home the point, e-commerce as a business is a pretty lackluster business. I think for most Amazon shareholders, you know that the entire retail segment doesn't have huge amount of margins. It's maximum 5%. I mean, if you have to compare it across other retailers like Walmart, Costco, etc., their margins are razor thin. But I think in my entire thought process, I do place a huge emphasis in the advertising business because just take a look at what Alibaba has been doing. So before ByteDance actually took the world by a storm, Alibaba actually had the biggest advertising revenue by leaps and bounds. The second place was Tencent, and Tencent only made up around 30 to 35% of Alibaba's advertising revenue back in 2020 and 2021. But of course, via the introduction of ByteDance and how it was the next in thing in the entire world, based on the 2021 recorded and consensus figure, ByteDance actually took over Alibaba in terms of ad revenue in 2021. But what I wanted to point out is that investors probably shouldn't underestimate the synergies between the e-commerce business and also the advertising business. And in my own humble opinion, I think in the last 5 years, Amazon's advertising architecture is criminally underdeveloped. And now it does seem like they're trying to supercharge this business vertical. So to further enhance this discussion, I'm going to quote a friend's experience on Amazon. And I quote, "Their first party data is super strong, better than any other big tech, I can tell you. That $3 CPC, which is cost per click on Amazon, is not the same as the $3 CPC on Google. The A/B split testing tools are basically what every other company should have built but have not. Another thing I've experienced is the scale of Amazon. They have scale and they have lots of it, especially if they favor you. Full funnel, zero attribution issues, data is absolutely perfect because they own the whole thing, from front end to fulfillment to all the HTML pages. So many of these are marketing terms, and if I can simplify it for a layman investor, Amazon are basically owners of the entire online commerce real estate back in the US and a major part of the world. And the architecture they're building behind the scenes is going to lock their partners in the Amazon's ecosystem, simply because there is nowhere else doing it better than them. So like I referred in the previous video, I believe Amazon's ad and third-party business is criminally underscoring its potential, and the street will be shocked when it starts raking in obscene amount of money. Of course, the typical impression of Amazon is still about e-commerce, Prime subscription, and AWS, and many of the other potential business lines that they're building in the future, which are all significant contributors to the Amazon story and valuation. So look at them on the aggregate as a package. Amazon, it's going to be crazy, and it's also going to be scary. Now, let's answer the most important question. Why would I consider buying Amazon now? If you're really so bullish, you should have bought them before earnings. Why pay a higher price now? Looking back, if I had the ability to forecast the future, I would have done a lot of things differently. But that's not the point. Investing is an uncertain endeavor, and we can all just try to make educated guesses and weigh the trade-offs. Anyway, Amazon has been executing in line with expectations, a very stark contrast to just 1 year back during their reinvestment cycle. And personally for me, I do see a clear runway for them to expand into. And of course, the valuations are not demanding, even after this run-up. So traditionally, most people use financial metrics like the P ratio or PS ratio for quick comparisons. But Amazon is a different creature which requires a different tool. So the consensus amongst many is to use the price to operating cash flow instead. And right now, they're trading right around 21 times price to operating cash flow. When you take $85 billion, which is the trailing 12-month operating cash flow, divided by a $1.75 trillion market cap, which is after the 6% gap up. So at 21 times price to operating cash flow, some might think it's expensive, some might think it's cheap. But historically, they're trading much closer to 25 to 30 times. So please understand that our circumstances are vastly different, and I might be buying Amazon at the highs of it. But I'm definitely betting on the longer term story, and I'm happy to be a shareholder of this business. So please do your own due diligence, and with that, I'll see you guys in the next video. But more importantly, I'll see you guys on the moon. Goodbye.